Ever wondered why there's been a sudden surge in Forex trading experts in Kenya? Could it all be a clever scam? Welcome to the world of Forex trading, a realm where knowledge is power and ignorance can cost you dearly. Recently, Kenya has seen an alarming rise in self-proclaimed Forex trading gurus, promising to make you rich overnight. But as the saying goes, if it sounds too good to be true, it probably is. Forex trading is not a get-rich-quick scheme. It's a complex financial market that requires skill, knowledge, and a fair share of caution. The proliferation of these so-called experts is a troubling trend, with many falling victim to their enticing yet hollow promises. The gravity of this issue is immense. It's not just about losing money, it's about the devastating impact on trust and confidence in the financial market. So, what exactly is Forex trading, and why is it often referred to as a zero-sum game? Stay tuned to find out. At its core, Forex trading is about buying and selling currencies in pairs. Just like the name suggests, Forex or foreign exchange trading is the act of exchanging one currency for another. It's a global marketplace where all the world's currencies are traded. Now, these currencies are traded in pairs, for instance the euro and the US dollar, EUR USD, or the British pound and the Japanese yen, GBP JPY. So, how does it work? Well, when you're trading Forex, you're not just buying or selling one currency, but you're buying one currency and selling another simultaneously. The first currency in the pair is called the base currency, and the second is called the quote or counter currency. Now, the base currency is the one that you think will go up or down against the quote currency. If you believe that the base currency will appreciate against the quote currency, you would buy the pair. Conversely, if you think it will depreciate, you would sell it. The idea here is to speculate on the price movement. If your speculation is right, you make a profit. But if it's wrong, you incur a loss. It's as simple and as complex as that. Forex trading operates on a bid and ask system. The bid price is the amount you can sell the base currency for, while the ask price is the amount you can buy it for. The difference between these two prices is known as the spread, which is essentially the cost of the trade. The Forex market is driven by supply and demand, which in turn is influenced by various factors such as economic indicators, interest rates, political stability, and even natural disasters. But here's the kicker. Forex trading is essentially a zero-sum game. Let's delve into that. In a zero-sum game, the gains of one player are exactly offset by the losses of another. And that's Forex trading in a nutshell. So, what exactly do we mean by a zero-sum game? Let's simplify it. Imagine a game of poker. The total pot of winnings is fixed. Every dollar you win is a dollar someone else loses. There's no magic money tree, the pot doesn't grow on its own. The same applies to Forex trading. The market isn't a magical money-making machine, it's a battlefield where the winners take from the losers. Now let's delve into how this concept applies to the Forex market. When you place a trade, you're essentially betting against someone else. If you buy a currency pair, someone else is selling it to you. If you profit, that means someone else took a loss. This is the harsh reality of Forex trading. It's a competitive arena where the strong survive and the weak fall. This brings us to the question, who benefits from this zero-sum game? Well, firstly, there are the brokerages. Every time you place a trade, they get a cut, whether you win or lose. They're like the house in a casino, always guaranteed to make a profit. Then there are the big corporations and institutional traders. With their vast resources and sophisticated algorithms, they often have a distinct advantage over individual traders. But don't let this discourage you. Remember, every game has its champions, and Forex is no different. However, it's crucial to understand the nature of the game you're playing. You're not just trading currencies, you're competing against other traders, brokerages, and corporations. To succeed, it's not enough to simply understand the market. You need to outsmart it. You need to be better prepared, more disciplined, and more informed than your competition. And this requires due diligence, stringent risk management measures, and continuous learning. Now that we understand Forex trading, let's take a closer look at these scams that are plaguing the industry. Forex trading scams are sophisticated and they're designed to deceive you into parting with your hard-earned cash. At the heart of these scams, you'll typically find a crafty individual or group with an intricate web of lies spun to lure unsuspecting victims into their trap. So, let's dive into the anatomy of a typical Forex trading scam. These scams often start with a promise of unrealistic returns. They paint a picture of a world where you could turn a few $100s into thousands virtually overnight, but remember, if it sounds too good to be true, it probably is. The foreign exchange market is complex and volatile, and even the most experienced traders can't guarantee such returns. Scammers also exploit a common lack of understanding about forex trading. They use complex jargon and technical lingo to seem knowledgeable and trustworthy, but beneath this facade of expertise, they're merely sowing confusion. By making forex trading sound overly complex, they trick you into thinking you need their expert help to succeed. Furthermore, they often create a sense of urgency, insisting that you must invest immediately to avoid missing out on a once-in-a-lifetime opportunity. This pressure tactic is designed to rush you into making a decision without doing your due diligence. Another common feature of these scams is the absence of transparency. Scammers are often vague about their trading strategies, and they may not provide clear information about fees or the risks involved. They might also operate through unregulated platforms, making it difficult for you to seek redress if things go wrong. Finally, some scammers even go as far as faking trading results to convince you of their legitimacy. They present you with impressive trading histories and testimonials from supposed clients, all fabricated to gain your trust. So how can you protect yourself from falling victim to these scams? The key to avoiding forex scams is due diligence and stringent risk management. When it comes to forex trading, knowledge truly is power. It's essential to educate yourself about the market before you dive in. Familiarize yourself with the basics of forex trading, understand the mechanics of a trade, and grasp the economic factors that can influence currency prices. There are numerous resources available for learning, from books to online platforms, such as FX which provides valuable insights and strategies for trading. Research is another crucial tool in your arsenal against scams. Make sure to thoroughly investigate any broker or trading platform you're considering. Look for reviews and feedback from other users, check their registration and regulatory status, and scrutinize their trading conditions and practices. But remember, even the most reputable broker is not a guarantee against losses. Forex trading is inherently risky, and it's crucial to have a solid risk management strategy. This includes setting realistic profit targets, using stop-loss orders to limit potential losses, and never risking more than a small percentage of your trading capital on a single trade. Also, be aware of the common signs of forex scams. These include promises of guaranteed profits, pressure to invest quickly, and lack of transparency about fees and risks. If a broker is not willing to provide you with clear, detailed information about their services, that's a red flag. Finally, maintain a healthy dose of skepticism. Scammers often prey on people's desire for quick and easy profits. If a trading opportunity sounds too good to be true, it probably is. Don't let the promise of easy money cloud your judgment and lead you into a scam. In conclusion, protecting yourself from forex scams requires a combination of education, research, and risk management. It's not always easy, but with diligence and caution, you can navigate the forex market with confidence. Remember, if it sounds too good to be true, it probably is. Stay safe in your trading journey.